Hello everyone. Let me begin with the update on the monetary policy review, where we saw 50 basis rate cut on the repo rate. It was a surprise in terms of the quantum of the rate cut, where contrary to consensus expectation of 25 basis, we actually saw 50 basis rate cut. While we have been long maintaining that we expected the terminal repo rate to be at 6.75% by December 2015 or early Jan 16, the timing to that extent was a surprise for us as well. But in the least, it was a pleasant surprise for the market in terms of both debt markets as well as the equity markets. What clearly triggered this 50 basis point move is that 3 out of the 4 occurrences which were expected have broadly materialized, which is a benign inflation. The CPI in August was close to under 4%. Second is a status quo on US rate hikes. Third is the transmission of rate cuts, the past rate cuts by the banking fraternity. And the fourth one, which did not really materialize, was the monsoon, which was below average in terms of expectations. But 3 out of 4 is a fairly good probability to go with. And to our mind, this big bang rate cut, as we call it, will set the momentum on for the real economy in terms of progressing in line, which has been anticipated by the governor and the government. What is the outlook going forward from the current juncture? Well, we believe there would be an extended pause mode, given that we have seen a front loading of rate cut. But are we done with the accommodating cycle? The answer is no. And that was quite evident in Dr. Rajan's speech as well, if you go through the review. So that gives us confidence that the monetary easing is likely to continue by taking an intermittent pause. Probably early part of 2016, as we get much more clarity on the CPI data, is where we could see another 25 basis rate cut, which would take your repo rate probably to 6.5% by March 2016 or probably early 2016 of April. The other additional positive, which we believe from an outlook standpoint, is the opening up of FPI, which is the foreign portfolio investment limit for sovereign bonds. That we believe would be a strong catalyst for yields to be supported in the near to medium term. If this is the view, what should be the strategies that investors should focus on? We still believe it's not too late to enter the duration bandwagon. We clearly believe that India is in a lower interest rate trajectory, albeit with a lag or a gradual pause. But we clearly believe that the government bond yield curve at the current juncture offers investment opportunities. So strategies like the Kotak Bond Fund and the Kotak Gilt Fund should clearly be on your investment radar with at least a minimum 12 to 18 month investment scenario. Given the recent equity market correction, we also believe strategies like Kotak Equity Savings Fund, which invests in marginal equity up to 25%, would be a valid proposition. To conclude, we maintain that the pros and the cons right now, the pros are slightly overweighted vis-a-vis the cons from India macro and India rate perspective. So the mantra clearly would be to elongate duration on your fixed income portfolio. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.